Vartak joins us now. Let's take the conversation forward with him. Samit, good morning. Good to connect with you. I'm going to start with a very simple question. Make sense for us of this market madness.
Yes, I think what I've learned is that I think a lot of investors try to think markets in terms of how physics works. With physics, you can predict what are going to be the movements of planets and the sun, and for probably centuries. Right? But that's not how markets work. Markets probably can be compared with how our neurons work, because there are too many market participants, and how the other participant reacts makes a lot of difference. Example, COVID. COVID without fiscal stimulus, without the central banks coming in, the impact would have been completely different. So you can't just think of a stock market and how it's going to have, what is going to be the impact of COVID on the economy, and that's how the markets are going to react, just considering those couple of inputs. We do not know what actions are going to be taken. There are too many moving parts for us to be able to forecast that. So I think the folly is that we try to put it into simple formulas, which really never work. I mean, who would have thought with economies going down by 30-35%, and the worst pandemic in a century, and the markets are way above what they were before the COVID started. So I think it's a humbling experience for most who try to think that they are way smarter than the market, but I think it's way complex than just thinking in terms of few variables and then trying to predict.
Given that the bent of the economy has changed, assumptions have changed, the comeback which looked up pent-up demand is now looking like a sustainable and a structural demand. How have you changed your portfolio orientation?
See, I think one of the biggest change which has happened is in terms of the quality of the balance sheet. I mean, I was just looking at the balance sheet of the non-large cap, so not the top 100, but and you would see that we are at the best net debt to equity ratio below 0.4 times, which I've never seen in at least this century. The interest cover, for last quarter, this quarter it will be even better, was at 7 times, which is never seen in the history of India, I guess. You look at the cash flow as a percentage of net profits, they are at the best point in time. And you will be surprised by the number of companies who have become debt-free. And a lot of these companies are sitting on at least 30-35% kind of unutilized capacity. So, I mean, going forward, I feel the operating leverage can kick in big time, because there is capacity for to take care of the demand that would come in. You would not need much of credit. Even who needs credit today, good companies are getting short-term CPs at 3.5%, 4%. So a lot of things have changed. You are just compare this with 3 years ago, 3.5 years ago. When we were in the previous bull market for the mid-cap, small caps, you were at all-time high P multiples, but the banking cleanup, the repercussions of that banks falling had just started. The cleanup of the balance sheet of mid-caps, small caps had just started. There were a lot of fraudulent companies which came out, and we had accidents after accidents over the next 3.5 years. Right? So today we are sitting on a very clean balance sheet, and the power of a clean balance sheet and a clean system is immense. I don't think we can predict that. So very different situation. Accordingly, your portfolio definitely has to change. I think the earnings growth will come into companies which are, which have taken these steps, which are sitting on huge unutilized capacity, and where, there is demand pickup, and the operating leverage, is something which we can't even predict. So look at the profit. I mean, a lot of fund managers, economists do talk about, the profits of corporate India versus the GDP. The ratio used to be 3% or 2.5% in 2000 to 2003, went up to 8% in 2007-8. Again, last year we had reached the same levels of 2%. I'm pretty sure, with the cleanup, the cost structure, the interest cost there where we are at, the profitability is going to go up. I mean, just in terms of percent, it can go 4x. So that's the potential that we have. So we can't just look at it from a valuation perspective and where we are, and then just compare it with those couple of variables with the previous instances. We got to look at a lot of other inputs, and that's how we can make a much educated probably forecast of where we could be.
Even though I'm an optimist, and we both are optimists, but for a minute I'm going to be in devil's advocate, and perhaps it's my job to ask a contrarian question. I'm going to quote Sir John Templeton here, and he said that the most dangerous words in the stock market is that this time it is different. There's nothing called different. If you are trading above historical benchmarks, which means markets are expensive, and if you buy markets at these levels, the future returns are not great.
Right. No, absolutely. I mean, see, I think what's not different each time is the sentiments of the investor, right? So in terms of sentiments, it's good to see that people are skeptical about this market. There is a lot of skepticism. There are a lot of smartest investors who are sitting on the sideline with, higher levels of cash. But you're right. After all, valuation is something which is going to be, the defining factor of what the returns are going to be going forward. And that's where, whatever view that say I may have or you may have, just being optimistic, main thing is how do you pick your portfolio? How do you build your portfolio? So I think there is no point in going all out and going for a hope trade. Even in this kind of environment where the economic situation seems to be much easier compared to, like, say, last 3 years, you will need to be as disciplined and strict in picking your portfolios. I mean, as I said, situation 3 years back in terms of valuation were worse. I mean, the midcap, small cap valuations at that time had reached 32, 33 times trailing multiple. Today we are at maybe 22, 23 times. So we are still 50% away from what we had reached in, say, December 2017. Right? But even with, that kind of cushion, it's better to go for companies which are already delivering. No point in going for turnaround stories and hope that maybe if you get it right, you will make way more money. But what if it goes wrong? Because it may not be different, and those words are absolutely prudent. That it may not be different, and we may go in similar kind of cycle what we went in 2017. So better that whatever view you may have, as an optimistic, but your portfolio should not reflect that optimism. It should still be defensive, that if you get a really bad pitch going forward, you should be able to defend it. So play it in a very defensive manner, but take an educated risk.
Samit, if I could probe that a bit further, and an ideal portfolio currently, if we're looking at still keeping it fairly defensive, what would you suggest? Would you suggest maintaining a fair number of IT, pharma names, the traditional defenses, but those that have run up so much and are looking kind of heavy and expensive now? Or do you mean more in terms of, as you mentioned, mid-caps with quality balance sheets? Just how would you really break it up, whether thematically or otherwise, to ensure that it was relatively insulated?
Yeah, so yes, my definition of defensive is not by industry. I would say what defensive means is that look at companies which deliver during tough times. For example, companies in, say, structural steel pipes where the industry wasn't doing well, but there are companies which doubled their earnings in the last 3 years. So that is what defensive means, is that in a tough environment, on a really bad pitch, the batsman was technically very strong. That is what defensive means. I am an aggressive batsman. My run rate is always going to be high. So I'm going to look for companies which will deliver higher growth. So within that universe, you got to go with companies where on a really bad pitch, they delivered. I don't want to go with companies which always need a very flat pitch. So that's how I would define. And in that, there are many companies. I feel going forward, I think the industries which may do well and which have been doing pretty well are going to be export oriented, manufacturing oriented. There is going to be a lot of manufacturing activities, and for that you will need a lot of building materials. So I've been talking about building material space over the last year and a half. And I think with the PLI scheme, with the incentive for manufacturing till 2023, there is going to be construction plus real estate is picking up. Infrastructure will pick up. So within the building material basket, again, you don't have to go with pure commodities. Like you don't have to go with pure commodities like metals, or because those are going to be very cyclical, where you will need to time it to exit. Whereas there are companies which will be a little more structural, that they were doing well in a bad cycle, but if there is a good cycle, they will do even better. But they will probably give you similar kind of upside, and there is no point in going for cyclical where you will have to exit, and if you get the exit wrong, you probably lose out on whatever you made during the upcycle.
Absolutely. From what you're saying, can I also deduce that you feel India will really be in a sweet spot among some of the other emerging markets? Because when we're talking about manufacturing, there have been so many questions around India's competitiveness vis-a-vis some of the others in the region. But given the kind of move and the kind of fund flows we've attracted over the last few months, even from China to some extent, and the kind of pickup we're seeing in that percentage, that does seem to suggest that over the next year or so, India could be in a relatively sweeter spot amongst the EM basket. Would you agree?
Because, as I said, as I started with, the power of a clean corporate balance sheet is immense. I think we will see the benefit of it over the next 2 or 3 years. That is something which is very different when you consider India with any other emerging markets. At the same time, the banking system is very clean compared to what it was 3 years, 4 years, 5 years, 10 years ago. So that also is going to help. Plus, Indian government really never went out and doled out fiscal stimulus. It was mainly schemes which were doling out loans. So it wasn't free money which was given out. So we are in a much fundamentally strong position. And with Biden coming in, with Democrats controlling both the houses, it's highly possible that there could be higher tax rates in US, and a lot of money had flown into the US market, which will come out and probably go into the emerging markets. And where is there a bigger opportunity than India? Because it's a large economy, plus there are triggers, with things like PLI, where government at least is now much more proactive. Hopefully they will go for divestment. So there are a lot of incrementally positive things which could happen, which may not happen in a lot of emerging markets. So I won't be surprised if within even the emerging market space, we would outperform. So I'm pretty positive. But as I said, what I feel and what I pick, there has to be defensive nature in that, which will benefit. But if it doesn't really play out, you should not, be sitting on things which will just collapse.
Samit, there's one thing wherein you have strong companies, earnings visibility on one hand, and the other part of the market is, of course, valuations. If I were to take a very myopic view, while only 32 to 35% of the Nifty numbers are out and you've got top-line growth returning, where is it that you personally find valuation comfort in the market right now?
Absolutely, there is not much of valuation comfort in the top 100 or top 200 companies. I think they are trading at historical high numbers, even if you adjust for the March and June quarters, which were impacted quarters. if you just look at the median valuation of the top 100 companies, it's like way above 40. Now it's 42, 43 times, which we have never seen. The highest we had reached in the previous cycle was 32, 33 times. So we are, almost 30% above. So even if you adjust for those couple of quarters, maybe that 42 will come down to maybe 38, 39, but still way above. I think beyond the top 200 stocks, that's where I think there is a huge valuation comfort compared to the large cap. Plus, I feel a lot of those companies have paid off their debt, which we have never seen in the last 20 years. So that's a big incremental change for that universe. I mean, they went through tough phase, and a lot of weaker companies have been shaken out. And at the same time, there is a lot of unorganized space, which I don't think have been able to sustain the shock of COVID as well as the adjustment of GST. So many of those companies are out of business. That business will be taken over by maybe the mid-cap and small-cap cap company. And you will, if you hear the commentary of a lot of the companies, you will see that happening in real time. So I think valuation comfort even in the P multiple is way higher in the mid and small cap space compared to the large cap, as well as I feel the operating leverage can kick in with incremental demand coming in, and even they are sitting on 30-35% kind of unutilized capacity with debt-free balance sheet. I think that's where the opportunity is.
So tactically, would you say that you're prudent to align your portfolio more towards mid and small caps for the next foreseeable future?
What one needs to do is, after all, the core for any returns is going to be earnings growth. So align your portfolio to earnings growth. If there is a large cap which gives you earnings growth similar to what a lot of high quality mid and small cap is, and what I mean by earnings growth, you got to target something which is the earning have to double in the next 3 to 4 years, right? Which definitely is extremely difficult to find in the large cap. So if you find something in the large cap, well and good, you go for it. But I think the what you look for shouldn't be based on market cap, but should be based on the earnings growth. And at the same time, valuation has to be reasonable. You can't be paying 100 times and 150 times for such a growth, because then it seems that a lot of that growth is already priced in. And if you go wrong in your estimates, then you're definitely relying a lot on luck. You're not prepared for accidents, so you're not definitely positioning your portfolio with a defensive batsman. And I think that's how I would look at make earnings growth as your core for looking for any companies. And if that's met, only then look at valuation. Valuation, you can little bit overpay. There's no harm in overpaying to get a quality batsman. But, do not go down the quality curve.
I'm looking at metals, and it's a downward spiral, not exactly a sell-off per se, but a downward spiral nevertheless has actually started. Tata Steel up and down, Vedanta flat. There is definitely a churn which is happening in the financial space. 5081 now for Bajaj Finance. We spoke about you like industrials, you like data companies, you like select names which pretty much are which will take benefit because of specialty chemical and what is happening in the chemical industry. What else have you added? What could be called as a new theme or a new idea?
So actually, I was stuck with the same kind of themes, because I believe that I never really went for real defensive themes like complete pharma or IT or consumer-oriented kind of companies. I stuck with companies which probably should not have been doing well in a difficult environment, but they did well. So it definitely they passed the stress test with flying colors. And when you are given a little better environment, I think they should do well. So really, I mean, absolutely, I haven't really made too many changes in the portfolio. It's just that, whatever themes you got wrong during a bull market, you just get a chance to get out of them. So those are the only, smaller tweaks I would do. That, some things that you thought will do well and did not do well, and you could not, because the prices were so low, you didn't find it reasonable enough to get out. Those are the only exits I'm doing right now, and then getting back into similar kind of theme. So I'm really fine paying a little bit higher valuation, but I don't want to sit on businesses which are basically weak.
While we have a restriction when it comes to talking individual stocks, but just for the benefit of our viewers, I want to bring out a point that Samit always believes that since he's managing client money, the idea is to generate superior return, and the objective here is to identify companies which can grow at 20%, which have strong ROS, which is return on equity, and do not have a huge leverage problem. And that typically is not available in the large cap space. That's the point I think he's trying to make out, and that's what stock pickers try to do, try and identify good businesses which are outside the comfort zone of HDFC Bank, Asian Paints, Britannia, or an HUL. Samit, we can talk about HDFC Bank being a crowded trade. Asian Paints, a great company but expensive stock. TCS, expensive, and it does not deserve a P multiple of 30 times. But whether it is last quarter, or whether it is 2 quarters ago, or whether it was 4 quarters ago, this is where growth is, this is where market share gain is, and these are fantastic businesses which continue to grow. Now, I buy the valuation argument, but when growth is so strong, how can one skip them?
No, absolutely not. I think what the point I'm trying to make is that their growth could be high, but then what is the benchmark for them, growth? So if you look at, say, Indian nominal GDP, growth is going to be 10, 11%. And if you get a growth in these companies, which is going to be more like 15, 16%, you will find these companies are, way superior growth opportunities. But what I'm talking about is way higher than that. What I'm talking about is doubling in 3 years, or, in worst case scenario, 4 years. So those opportunities are not existing in these kind of companies. I mean, they did exist maybe before. And so, it's just matter of, what kind of growth you're looking for. Absolutely, for someone who's looking for 15, 16% kind of a return, these are great businesses. And especially for FIIs, these kind of growth numbers are something that they don't get anywhere else in such large companies and such large leaders. So depending on what the investor is looking at, these are attractive opportunities.
Thanks so much for joining us this morning. Always great catching up with you and getting a sense of how things stand and your outlook going forward.